You guys and girls can see Federal Reserve. We're going to listen in on the Federal Reserve just went live today. He's going to be talking about raising them interest rates 75 basis points. Let's tune in. Let's see what the Federal Reserve got to say. Mr. Jerome Powell for himself. This was just a couple of hours ago, but we're going to keep it fresh and come with the commentary here on the Investor Show to kind of see what we're talking about and to see what's coming next. So y'all listen to this. We stick around and we're going to talk about what's going down next. Here we go. Jerome Powell.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today,
Hey, I made a mistake here. The Opinion Sports Show, you put in something very great there. You said, why did the market rally when we get a Federal Reserve rate hike? The thing is, we are expecting rates to go up. We just had inflation at 9.1%. So when you've seen, it's kind of the market has already baked in the Federal Reserve position. I was going to put up your comment, but I clicked on the wrong button, the Opinion Sports Show, and messed around and blocked it. I don't know why I hit the wrong button there, but I did goof that off, and I can't bring it back for some reason. So my apology to the Opinion Sports Show. He said, why does the market always rally when we see a Federal Reserve hike? Many times is that this is already baked in. You got to think about it, ladies and gentlemen. We've been at zero interest rates for the longest, which is very bad for an economy. When you have zero interest rates, this pushes up asset prices. This is why we've seen the stock market go up for 10, 12 years straight. This is why we've seen the housing market go up, all the other things like that. So now we're bringing back these interest rates. We're seeing the market go down. We're seeing the housing market start to cool off. Some other things that he's going to hit on. So we're going to keep it going. Yvonne, what's going on, Yvonne, from Minneapolis? What's going on there? What's going on there, Yvonne? Thank you for tuning in. And Dr. Umer's Kuhn Academy. I don't know what you're saying there. It's just Dr. Umar Johnson, I'm guessing what he's saying, his academy. He's saying, yeah, what's going on? All right. So let's keep going. Federal Reserve, Jerome Powell. Let's go.
Today, the FOMC raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
That's a nugget right there. What did he just say? The Federal Reserve is doing all they can to reduce their balance sheets. This is just a fancy way of taking money out of the market. Remember, back in the pandemic happened, we're adding to our balance sheets. We're adding positions to our balance sheet. What does that mean? They're buying stocks. They're pumping money into the market. Now they are reducing their balance sheets. What does that mean? They're selling off all of these stocks. They're pushing these things away to cool down the economy. So they're reducing their balance sheets while they are raising interest rates. So you're doing two things is going on. Interest rates are going up. They're reducing that balance sheet. That's probably why you see your S&P 500, NASDAQ, and your Dow Jones all down almost about 20% so far this year. Jerome Powell, keep going.
Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated.
People ask me all the time, Prince, what are you talking about? He just hit him. He just said the labor market is still extremely tight. What does he mean? Unemployment is still low, ladies and gentlemen. Unemployment, the last time I checked, was at 3.6% on the last report of the job status that Bureau of Labor Statistics put out, right? So why are we having this? Jobs, unemployment is a lagging indicator. It's not something that happens in the beginning of a drawdown or recessionary period. This is something that's slowly going to happen. We just saw it. Spotify talking about laying off. Apple talking about laying off. Walmart talking about laying. All these companies are talking about laying off. Layoffs don't happen overnight. They don't pop up on the unemployment line. This is going to slowly happen. So right now you're saying, hey, the labor market is still tight. Unemployment is still low because the Federal Reserve has two jobs. One, maintain maximum employment. Two, keep inflation at a good rate, which is at 2%, which is keeping everything affordable. And right now they're saying, yes, inflation is going out of control, but unemployment is still looking pretty good because unemployment is a lagging indicator. Just like real estate, it's on the way. Let's keep an eye on it. Keep rolling that beautiful, beautiful beam.
Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, there we have it. Right now, let's ask yourself this question. So what? What is the so what factor? I like what Jonathan said here. I'm going to read this. Jonathan commented and said, I can't wait for more than just a recession to occur. This is going to get bad. The individuals controlling our government and economy are about to do something crazier than we can imagine. What we're doing right now, ladies and gentlemen, this is the economy fixing itself. We rolled at low interest rates for so long. Now the economy is doing something to where we have to push the interest rates back up. Now my question is, now that we see this, so what? What does this mean? What is next? I think that what you're going to see is, I'm going to pay attention to consumer discretionary, right? We're going to see credit card balances start to increase, Visa, MasterCards, because we know money don't disappear. It just goes somewhere else. So what we're seeing right now is unemployment is still pretty low and stabilized, but we're seeing interest rates go up, mortgage rates starting to kind of go up and stabilize. The real estate market is starting to cool off a little bit. It's going to flip into a buyer's market. Right now, it's a seller's market. We're going to see that happen. We're going to see unemployment start to rise. We're going to see people start to carry more debt. Household debt household debt is going to start to increase. That's my belief. We got to see what is going on next. What does this mean? So right here, Dr. Umar says, prepare while you can, but keep in mind we're going through a storm. We will be okay. You definitely will be okay. So I tell people all the time, people wonder about the recession. Oh my God. Yes, cash is king. But how long does a recessionary period happens? Somewhere between 12 to 18 months. Meaning by next Christmas, not this Christmas, but next Christmas, we'll be out of this mess and back on to better days. So, but this is the thing about it. The millionaires, billionaires, trillionaires are made during recessionary periods. This is the time. This is the time. Guess what? I'm keeping an eye on those foreclosures. I'm going to be doing episodes. I'm keeping an eye out in my county, my city, to see if foreclosures starting to go up. I want to get into the tax lien market. How many people can't pay their property taxes? How many houses? Look at these people who stretch themselves thin to get into these houses. My neighborhood, the average house now is somewhere between $600,000 and $700,000, right? $600,000 to $700,000 at a 5% interest rate. And I know the property tax in my neighborhood is about $500 to $600 a month. So alone, I know these mortgages are running up $4,000 plus a month. What's going to happen when that unemployment starts to hit? What you think is going to happen to all these people who did whatever it took, who lied on that application just so they can get that $700,000 home that they really couldn't afford? Foreclosures are going to come up. Tax liens, people not going to pay their property taxes. These are the things I'm preparing for. I'm looking at that foreclosure market. I'm looking at that tax lien market. Things that people who overextended themselves, who went out and bought boats and planes and all those stuff like that, that are now going to start to have hard times. Because guess what? When my mortgage, the only two bills, the only bill I really care about in my house is my mortgage. Everything else I really don't care about, right? I can live without a vehicle. I can live without lights. I can live without water, all the good stuff, but I care about my mortgage. That's the biggest thing. But so that means that when mortgage prices go up, I lose my job. I lose my source of income. I'm going to pay the mortgage first, but I will let my truck go back. I will let my car go back. I will let that boat go back, right? That's when I can see this foreclosure market starting to pick up, where you're going to probably be able to snag some things. I'm very interested to see how this plays out. So prepare yourself. Remember, cash is king. You saw what Elon Musk did, right? What Elon Musk did. Oh, I'm sorry, y'all saw what Elon Musk did. The first thing Elon Musk did as soon as money got tight, he sold his Bitcoin and went to cash. He sold his Bitcoin and went to cash because he knows cash is king as he's preparing for a downturn on the economy. But I don't want to sit here and talk too much. Federal Reserve Chair Jerome Powell just put out some good information. 75% base points. I would give a congratulations because everybody got that right. I had a poll on what people would do. LinkedIn, everybody said about 75%. And on YouTube here, everybody said about 75%. So 75% it is. All right. Well, there we go. Federal Reserve Chair Jerome Powell, 75 base points. That's what we got. Let's keep an eye out as we get ready for that this drawdown period. And tell me what you're planning. What are you going to do preparing for the next recession or drawdown? All right. Well, until next video podcast, cartoon, or whatever else crazy y'all see me do around the globe, y'all already know my name is Prince Dykes. I'm the Prince of Investing. Make sure you go down below and hit that Contribute app. Donate. If you haven't done so already, donate to that Contribute app. The Contribute app, every dollar that is donated is been matched by the Contribute app to give out the Wesley Learns book series to kids, every kid in America. So please help me, y'all. Help a brother out on my program. If you like what I do, if you like the books and things like that, follow this campaign. Contribute. Thank you. All right. Until next video podcast, cartoon, or whatever's crazy you see me do across the globe. My name is Prince Dykes. I'm out.